Good morning and welcome everyone. Thank you for joining us as we provide investment performance update for the fourth quarter of 2025 for the Sanlam Umbrella Fund's investment portfolios. My name is Solitsie, Head of Investment Strategy at Sanlam Corporate Investments. Today we have our investment specialist who will be providing updates on various portfolios of the Sanlam Umbrella Fund, underpinning the investment strategies of the Sanlam Umbrella Fund. Just in terms of the housekeeping rules and the guidelines for this webinar, cameras, microphones have been disabled for the smooth running of the webinar. And given that the mics are also muted, we'll be taking questions at the end of this webinar. There will be a Q&A button on the toolbar. When we get to the end of the webinar, please click on this toolbar to be able to type the Q&A questions that I will facilitate. For people who are not able to join this webinar now, a recording will be sent to them right after the event. Just in terms of the lineup of the speakers, we have myself. I will be providing markets and economic overview just as a backdrop to the investment portfolio performance. Megna, Matimu, Adash, and Zanele will be covering the various investment strategies of the Sanlam Umbrella Fund. Now, just getting right into it in terms of what happened in the investment markets, 2025 was a good year for investment portfolios. The investment markets performed exceptionally well. In terms of what happened in South Africa, so the shares on the JSE over a 1 year period delivered 42.4%. So stellar returns, listed property delivered 30.6%, even government bonds delivering 24.2%, well over 20% mark, and also global asset classes doing well again there. But because of the rand strength against the US dollar, the returns on the offshore markets were lower than the returns on the local assets as well. So these strong returns also filtered into 3-year numbers, 5-year numbers, and also the 10-year numbers. If you look at the 10-year numbers, double-digit returns across the major asset classes. So South African equities delivering 12.4% over the last 10 years, nominal bonds delivering 11.5%, and also global equities delivering 12.5%. Over the 1 year period, most of the performance on the South African shares came from resources. If you look at the second line from the bottom, the resources delivered a staggering 126% in terms of returns. Other sectors of the markets also did very well. Financials delivering 27.4%, industrials delivering 18.1%. This investment market returns ensured that members earned healthy returns in their portfolios, irrespective of the investment strategies that they're in terms of the investment strategies that they are invested in. If we go to the next slide, just talking about further supporting the numbers that are shown. Gold did really well over 2025 due to various factors that I will touch on, and also the all share index having a healthy weight into commodity shares also following suit as well. In terms of the global themes, what happened last year, the year was not smooth, so the returns did not come in a straight line. We entered the year with the inauguration of the US President Donald Trump having been elected last year. In fact, the first quarter of last year delivered negative returns, and this is usually due to the US Liberation Day, where President Trump announced tariffs to the countries trading with the United States. Although this looks like a distant memory at the point in time, this was a tough period to be in. Markets did sell off quite a lot. We've seen a couple of major central banks cutting interest rates. So the European Central Bank cutting interest rates on a couple of instances, and also the US Federal Reserve Bank cutting interest rates for the US economy. We've also seen gold surging to record levels, fueled by a number of things. Firstly, because of what's been happening in the United States, investors have been finding alternative sources of safe haven, and gold, in line with its role that is played historically, was seen again as a safe haven for investors, but also gold was classified as a favorable asset class for banks to hold it. So that also propelled demand, etc. And those are just a few factors that helped propel the price of gold. Just looking at the stock market did really well, creating wealth for retirement fund investors, other institutional investors, and also some of the richest people in the world. So Elon Musk actually just before the end of the year reached the 500 billion mark in terms of net worth. For the latest figures that are available suggest that Elon Musk is worth well over $800 billion in net worth. If we look at locally, also it was eventful. Maybe just before we go there, we can look at the forward, we can expect in the future in terms of the global themes. We do expect the uncertainty to continue, and the tariffs and the trade agreements playing a central role in all of this. The US very much focusing what is good for the economy, and also the US foreign policy will be important in terms of what plays out in the economy. The latest numbers from the IMF suggest that the global economic growth will hold steady at 3.3%. The US leading the charge there in terms of the developed markets. So US is expected to still grow faster than the rest of the developed world. Emerging markets will grow more than the developed world. And then South Africa is also expected to grow by just more than 1% this year. So a low growth from South Africa. Sentiment remains mixed. The global economy has been remarkably resilient given unfavorable events that are happening there. So sentiment is a bit mixed at the moment. Geopolitics are a risk to what's happening in the economy. There's still war happening in Russia and Ukraine. There are tensions in the Middle East, etc. So should they permeate beyond the borders where these conflicts are, they would be negative for investment markets as well. Artificial intelligence has helped propel productivity of the large companies around the world, including those listed, and it's partly why we have seen good returns globally as well. It is still a mixed bag because in the real economy, the impact that this will have will be both positive and negative. Positive that AI is expected to boost productivity, but there could be some jobs that are displaced. There has been some currency fluctuations around the globe. The US dollar weakening in general compared to other currencies. In general, emerging markets currencies have been strengthening, and South Africa has also had their currency strengthen as well. Global debt, in terms of how much governments have been borrowing, is becoming a concern. In fact, developed markets also being dubbed as being over-indebted. So this is something just to watch very closely. Locally, in terms of the developments, if you go to the next slide, a few developments there as well, seeing good returns overall. So the all-share index delivering staggering 42.4% as well. There were some developments. The South African Reserve Bank also on a rate cutting cycle there, so cutting the first, second, and third quarters of the year, and also the last meeting of the year. So this also helped propel the market. Some of the things that boosted sentiment in South Africa was the removal of the country from the grey list. If we look at what we can expect from the South African economy going forward, the next slide shows a couple of themes there. So sentiment was also helped, good sentiment was also helped by the stability of the government of national unity. So the stability of this coalition government going forward is key. We have been seeing some green shoots in infrastructure. So we need infrastructure to be developed to increase economic capacity and also to grow our economy. Within infrastructure, energy security is key. Starting with Eskom, we have been seeing some favorable developments there in terms of strengthening government processes within Eskom, and also the anticipated division of that Eskom in terms of having different entities playing differing role in terms of manufacturing, transmitting, and also distributing electricity and energy. Also, what's been favorable is that the government has allowed the private sector to play a meaningful role in the provision of energy, which has been positive. So this is something to watch closely and also to pay attention. Operation Vulindlela, which spans across various infrastructure objectives, so including adequate energy provision, but also water, telecommunications, etc. We have been seeing some green shoots there, so the sentiment looking good overall. In terms of government debt, this has been spiraling, upward, getting to unsustainable levels. It was encouraging to see the National Treasury's projections late last year, where government debt is expected to peak this year when that's expressed as a percentage of GDP going forward. So should we see the government debt reducing, this will be favorable in a couple of ways. One, directly, this will boost government spending in the other priorities, and this may help also reduce the interest cost that is incurred by the government. But secondly, this is also good in terms of government bonds as an asset class, but also good as boosting sentiment in the investment markets overall. I'll also touch on inflation and interest rates. So interest rates have been reducing quite steadily over the last while. This is because inflation has been under control. An important development is the South African Reserve Bank changing the inflation targeting. So we have historically been targeting inflation of between 3% and 6%. Now the target is going to be 3% with a 1% leeway on either side of the target. So the thinking here is that if we can keep inflation under control and also make sure that the purchasing power of money or the rand is kept steady, this will be favorable overall within the economy. I touched on the removal of South Africa from the grey list. That also had helped in terms of the sentiment, but also in terms of the performance of the government bonds as well. We have been, as a country, enjoying the commodity boom that we have been seeing. Our companies have participated in that, which means that the government has also been collecting good taxes on those kind of revenue. So this has helped in terms of the government finances as well. There is 2026 local government election coming up. By law, this has to take place between November and February next year. The date is still yet to be announced. The importance of that is, that can sometimes act as a precursor to what we can see in the national elections. So overall, good sentiment for the South African economy. South African investment markets have done really well. We've been seeing some of the sentiment starting to turn into fundamentals in terms of what's happening in the real economy, and we need a lot more to happen so that we can boost the South African low economic growth, so that we can tackle the issues such as high unemployment that is happening in South Africa. So that's it in terms of the markets and economic overview. We will now go into the specific the report back on the portfolio performance, and Magna will be starting with that in terms of reporting on the Sanlam life stage strategy. Over to you, Meghna.
Thank you, Sally. Hi, everyone. My name is Meghna Batoy, and I will be taking you through the Sanlam life stage strategies. So just to explain how these life stage strategies work is that there's two phases. There's the accumulation phase and the preservation phase. And in the accumulation phase, members will start off being invested in one of 4 portfolios. And the focus in this phase is on growing the members' fund value by maximizing their returns. And then when the member is 6 years away from retirement, then we gradually switch them over from that accumulation phase portfolio to the more conservative capital protection portfolio. So over the next few slides, Matimu and I are going to take you through these 4 different portfolios that members can choose from in the different life stage strategies. So I'm going to start off by going through the first one, which is the Sanlam life stage strategy. And in this strategy, members are invested in the Sanlam accumulation portfolio. So this portfolio combines both passive and active investment strategies to get exposure from various asset classes and markets, and that enhances the overall performance. And the expected long-term return of this portfolio is greater than inflation plus 5%. And this portfolio has a higher allocation to equities. So it's a really good fit for members who are more than 6 years away from retirement, because when you're in that accumulation phase and you have that longer investment period, there's enough time for your investments to bounce back from any short-term market drops. And that allows you to take on more risk. And now if we look at the asset allocation, we see that Sanlam accumulation is overweight in SA equity and SA alternatives, and that has positively contributed towards its performance. And by looking at the allocation to equities and the growth assets, we see that it is a moderate aggressive risk profile. And then if we look at the performance of Sanlam accumulation, we see that it's kept up with its benchmark over the long term. And over the 1 and 3 year periods, it did really well. The portfolio produced a strong return of 22.2% in the 1 year and 18.1% in the 3 year period. And now I'm going to hand over to Matimu for the second strategy.
Thank you very much, Meghna. So we now go into the Sanlam passive life stage strategy. Where we are using the Citrix Enhanced Balance Checker Fund as the underlying portfolio within the accumulation phase. And in the next slide, we start showing the asset allocation for the portfolio relative to the benchmark. But what is also important to note is that the Citrix Enhanced Balance Checker Fund is an index tracking portfolio. By that, we mean we are not deviating a lot from the benchmark in terms of the way we allocate across various markets, but we do have a room to deviate slightly from the benchmark, as we can see there in the asset allocation of the portfolio versus the benchmark. When we look at equities to end of December 2025, which was end of last year, we were overweight in local equities compared to our benchmark at around 43.6%. Our benchmark allocated around 40%. And if we look at international equities, we were underweight there compared to our benchmark. And the two positions, being overweight in local equities and being underweight in international equities, has really helped the portfolio relative to the benchmark. But overall, we can see that this is a growth portfolio. So if you combine the South African equities and the international equities, the total asset allocation is operating at around 74%. So the portfolio allocates heavily to growth assets, particularly equities. We do have some exposure to bonds as well, around 19% of the portfolio. And at end of December 2025, we were allocating more to bonds compared to our portfolio. So as we can see there are also other asset classes such as the international property, international cash, as well as offshore infrastructure. And if we go to the next slide, this shows how the portfolio has performed relative to the benchmark at the back of us allocating, relative to the benchmark in the previous slide, which we have seen. And we can see there over the last quarter of 2025, which ended in December 2025, the portfolio returned around 5.2%, which beat the benchmark, which returned around 4.8%.
So we don't expect the portfolio to outperform the benchmark or to underperform the benchmark by a lot. And the reason for that is because the Citrix Enhanced Balance Tracker Fund is an index tracking strategy which aim to perform in line with the benchmark. But because of the flexibility which we have given our manager there within the portfolio, we are able to add value in the portfolio from time to time, such as this, which we have seen over the last 12 months, indicated by the one-year return there, where the portfolio did a return of around 23.8%, outperforming the benchmark, which gave a return of around 22.9%. And over time, we can see that the portfolio did add value over and above the benchmark there by the bars, which is representing the portfolio performance in blue, being above the bars in green, which is representing the benchmark return. So we are comfortable with the performance of the Citrix Enhanced Balance Tracker Fund, and we can see there that the action within the portfolio are also adding value in the portfolio, in addition to it being a low fee portfolio within the life stage strategies. And I'm now going to hand over back to Meghna to take us through the Sanlam Blue Life Stage strategy.
Thanks, Matimu. Before I carry on, just a reminder that if you have any questions, don't be afraid to use the Q&A function. So now I'm going to move on to the third strategy, which is the Sanlam Blue Life Stage strategy. And this is similar to the first strategy I went through, but the only difference here is that with the Blue Life Stage accumulation portfolio, this strategy is single managed, but the accumulation portfolio that I mentioned earlier is multi-managed. That's just the main difference. Now, the Blue Life Stage accumulation portfolio is made up of a 50-50 split between SPW Balanced Fund and Sanlam Multi-Asset Growth Fund, with around 45% invested in SA equity and 28% invested in international equity. And that makes it a moderate aggressive fund. And if we look at the performance on the next slide, we see that it did really well in the one-year period with a return of 22%. And it's done well over the long term relative to the benchmark as well. Then if we just take a deeper dive into the individual parts, so if we look at Multi-Asset Growth Fund, that's also a moderate aggressive fund, and its benchmark is the Alex Forbes Global Large Manager Watch Medium. And we see that it's outperformed the benchmark since its inception, since in November 2024. And then if we look at the other part of Sanlam Blue, that is SPW, and that's also a moderate aggressive fund, and it's performed well compared to its benchmark in the long term as well. Finally, I'm going to hand over to Matimu for the last strategy.
Thank you very much, Meghna. Now we are on the fourth life stage strategy, which is the Sanlam Wealth Creation life stage strategy, part of the default life stage strategies within the fund. And we start with the asset allocation on the next slide, but also to remind ourselves that the Sanlam Wealth Creation life stage strategy is a multi-managed strategy, meaning that we are allocating to various managers. But in addition to that, we are also allocating to various strategies within the portfolio. So we start with the asset allocation, which is showing how much the portfolio has been allocating to end of December 2025. And we can see there that majority of the assets as at December 2025 was allocated to local equities at around 45%. And then also, if we look at international equities, a significant portion there of the portfolio at around 31.5%. So one can really see that there is a significant allocation to equities within the portfolio. And in fact, we were operating at a maximum level allowed by Regulation 28 for equity allocation within the portfolio. And in that light, we also allocated to other growth assets, such as alternative investments there at around 7.5%, but we also allocated to property there at around 3% within the portfolio. We also do have some allocation to bonds at around 8.6% of the portfolio, which is slightly low compared to other portfolios in the market, but we also have diversification within the international assets as we are allocating also to property and bonds within the international markets. And if we go to the next slide, which shows that indeed the Sanlam Wealth Creation portfolio is a multi-asset, multi-managed portfolio, meaning that we are allocating to various asset classes and we are also allocating to various managers. And if we look at our local strategy, where we are allocating to what we call local balance managers, whom have been given a mandate to buy shares, to buy property, to buy bonds within their respective portfolios. So these, we call them the local balance managers. So we are allocating to the likes of Fairtree, Abex, All Weather, Coronation, Camisa, and 91 within the Sanlam Wealth Creation portfolio. And these managers, we have done a lot of research on to identify them, and we do believe that they add value in the portfolio, as we have seen in the track record of the portfolio. We also allocate, in international assets. And if we look at the equity portion there, we have various strategies within the international market. We have the listed infrastructure. We have the multi-managed global equity. We also have structures such as the portable alpha strategies within the equity. We also have the passive equity within the portfolio. So it is indeed a multi-asset portfolio, and as well as multi-strategy portfolio, allocating to various strategies as well as different managers. And in this next slide, we are going to see the investment performance. So what we are seeing here is the performance of the portfolio relative to performance of the benchmark. So as we will remember that last year in December 2024, we actually updated our benchmark from what was a composite benchmark to a peer relative benchmark. So the benchmark history which we are seeing here is a mix of returns showing peers since 2024 December, as well as composite benchmark before 2024 December. And the blue bars are showing the performance of the portfolio. The green bars are showing the performance of the benchmark. And as at Q4, quarter 4, 2025, we can see there that the portfolio returned 4.5, which was ahead of the benchmark return of 4.3%. And if we look at the year overall in 2025, in terms of how the portfolio has done, it has done around 20%, which underperformed the benchmark, which returned 21.9%. And when we dig deep into the performance numbers to see why we did underperform the benchmark in the year 2025, we also acknowledge that our managers within the balanced mandate within the portfolio, they were actually underweight in resources stocks compared to other managers in the market. As a result of that, when resources markets did well, which put the South African equity performance numbers high, we didn't participate a lot in those stocks. And as a result of that, we did underperform the benchmark. And another aspect which we have seen is that, in our private market allocation, within the portfolio, the private markets, they did well in line with the mandate of outperforming inflation plus 7%. But when we look at compared to other asset classes such as bonds, they lagged, and that is the reason why we underperformed the benchmark during that period. And as a result of that, our 3-year numbers has gone down to 17.1% compared to 18.7% within the benchmark. Over the past 5 years, we have performed in line with the benchmark, and since the inception of the portfolio, we managed to outperform the benchmark within the portfolio. So now I'm going to hand over to Adash to take us through the protection strategies as well as the capital protection portfolio.
Thank you so much, Matimu. Hi, everyone. My name is Adash Sundarprasad, and I will be taking you through the preservation phase of our life stage model, as well as the protection strategies offered by the Sanlam Umbrella Fund. We look at the next slide. These strategies utilize the Sanlam Smooth Bonus portfolios as the underlying engines. Sanlam Smooth Bonus portfolios aim to reduce the impact of market volatility on a member's retirement savings journey. They do provide real returns by smoothing investment returns through stable, predictable bonuses over the short term. We're also proud to say that no member invested in our portfolios has ever received a negative return. This includes during the financial crisis of 2008 and 2009 and the COVID lockdown of 2020, despite significant market downturns in both periods. Now, if we can zone into the preservation phase, when members are 6 years away from retirement, they enter the preservation phase, and their retirement savings gets transitioned into the Sanlam Capital Protection portfolio. And as the name says, this portfolio is mainly prioritizing protecting a member's capital and safeguarding a member's retirement savings by delivering positive and stable returns over shorter periods. We look at the asset allocation on the next slide. We can see roughly 50% allocation to equities, while also maintaining allocation to other growth assets like property and alternatives to ensure that members still receive real returns. If we look at the performance on the next slide, we can see that the capital protection portfolio has done exceptionally well against inflation over the 1 year and 3 year period, returning 8.1% real return over the 1 year period and a 7% real return over the 3 year period. While this is exceptional, we do not expect consistent significant outperformance against inflation. However, the portfolio still managed to return good real returns over longer periods like the 5 and 10 year periods. If we look at the next slide, saving for retirement can be challenging, and market volatility can make the journey even more uncomfortable for members. The Sanlam Umbrella Fund offers 3 protection strategies which are designed to ensure that your entire investment journey is smooth and that you can save and retire with confidence. The protection strategies are designed to protect your retirement savings against uncertainty and market volatility by providing various levels of capital guarantees. So first, we have the Sanlam Secure strategy, which uses the Sanlam Monthly Bonus Fund as the underlying portfolio. The underlying portfolio for the Sanlam Stable strategy is the Sanlam Stable Bonus Portfolio. And in the case of the Volatility Protection strategy, it partners the Monthly Bonus Fund with the Satrix Enhanced Balance Tracker Fund, which is an aggressive passive portfolio. On the next slide, we will zone in more to the Sanlam Secure strategy, which uses the Sanlam Monthly Bonus Fund as the underlying portfolio, which offers full guarantees on capital invested and bonuses declared. So if we look at the performance, we can see that a similar picture to capital protection portfolio has done exceptionally well in the short term against inflation. Over the 1 year period, the portfolio delivered 10.7% against inflation of 3.5%. And over longer periods, over the 10 year period, the portfolio has delivered 7.8% against inflation of 4.8%, providing members with strong real returns over the long term. Next, we can look at the Sanlam Stable strategy, which uses the Sanlam Stable Bonus Portfolio as the underlying portfolio. This offers full capital guarantees with partially vesting bonuses. On the next slide, if we look at the performance, we can see, again, the portfolio has done exceptionally well in the short term against inflation, with the 1 year return being 11.6% against inflation of 3.5%. However, for longer periods as well, the portfolio has continued to provide strong real returns to members, with a 3.7% real return over the 10 year period. In the case of volatility protection strategy, it uses a 75% split between monthly bonus fund and 25% Satrix Enhanced Balance Tracker Fund. In the next slide, we look at the asset allocation, which uses this approximate split to determine the allocations to each asset class. Here we can see allocation to growth assets like equity, infrastructure, property, and alternatives to provide members with real returns. On the next slide, we can see the performance. Over the 1 year, the portfolio provided a strong return of 14%. And over the longer periods as well, it's provided strong real returns. Strong local market performance has positively contributed to this, specifically from the Satrix Enhanced Balance Tracker Fund, as this is an aggressive index tracking portfolio. Overall, we are pleased with the performance of the Sanlam Umbrella Fund protection strategies, not just in providing good real returns, but remaining resilient in protecting members' capital, empowering members to retire with confidence. I will now be handing over to Zanele to take us through the member choice menu.
Thank you, Adash. Good morning, everyone. My name is Zanele Buthelezi. I'll be taking you through the member investment choice portfolios. So these portfolios are available to members to allow them to choose how their money is invested based on how much risk they are comfortable taking. The Denka SCI Balance Fund and the Satrix Global Achiever Fund have been added to the trustee-approved investment menu, while the Sanlam Progressive Smooth Bonus Fund was removed from the menu. The portfolios are grouped into 4 broad risk categories: cash, conservative, moderate, and moderate aggressive. Lower risk options offer more stability with slower growth, while higher risk options aim for higher long-term growth, but this comes with greater short-term volatility. This slide illustrates how the portfolios are structured along the risk-return spectrum. On the vertical axis, we show the potential return. On the horizontal axis, we show risk expressed as volatility. The key principle illustrated here is that expected return increases as risk increases. It is important to note that these portfolios are not designed to compete with one another. Each category serves a different member objective and risk tolerance. Performance must therefore always be assessed relative to the portfolio's risk profile, its strategic asset allocation, and its long-term objective. Comparing a cash portfolio directly to a moderate aggressive portfolio without adjusting for risk would be inappropriate. Another consideration is that given the clear increase in volatility as members move up the risk spectrum, any decision to move away from the fund's default strategy into one of these portfolios represents an active decision. Members are therefore encouraged to consult a qualified financial advisor before switching. This ensures that their selected risk profile aligns with the retirement time horizon, reflects their risk tolerance, and supports their long-term retirement objectives. So switching based purely on recent performance can materially compromise retirement outcomes. The next slide shows moderate aggressive portfolios ranked from highest to lowest return over 1, 3, and 5 years. As expected, these portfolios exhibit higher return dispersion due to their elevated equity exposure, corresponding volatility. Over 1 year, the performance differences are more pronounced, reflecting short-term market movements and equity sensitivity. Over 3 years, the dispersion narrows slightly, with returns clustering more closely together. And over 5 years, we see more consistency in outcomes, which reinforces the importance of re-evaluating higher risk portfolios over longer term horizons. So the key message that we can take from this slide is that these portfolios are designed for long-term capital growth and will naturally experience greater short-term volatility. Performance differences over short-term periods should be interpreted within the context of higher risk and market exposure. The next slide shows us the moderate aggressive portfolios. The moderate portfolios ranked from highest to lowest over 1, 3, and 5 years. As expected, these portfolios exhibit higher return dispersion due to their as expected, these strategies aim to deliver steady capital growth with moderate levels of volatility. And we're seeing that over the 1 year period, we observe some dispersion in returns. And this also reflects the differences in asset allocation, positioning, and market exposures. The 3 year performance has also become clustered, indicating broadly similar risk exposures across the category. Over the 5 years, there is more consistency. Reinforcing these portfolios should also be assessed over the longer term horizons. The moderate portfolios are designed to balance growth and downside risk. So variations in shorter term rankings are expected and should not drive switching decisions. Lastly, the cash, we've got the cash and the conservative performance over 1, 3, and 5 years. So these portfolios, they sit on the lower risk spectrum and are designed to prioritize capital stability and reduced volatility. We've got the enhanced cash fund, which reflects stable interest rate driven returns across all periods. We've also got the monthly bonus and stable bonus portfolios, which show slightly higher returns consistent with their smooth return structures and limited exposure. And then we've got the SMM30 portfolio, which demonstrates higher returns over all portfolios, reflecting their increased growth asset exposure within the conservative category. The key message that we are taking from this slide is that Return differentials within this group are driven by differing levels of smoothing mechanisms. There's lower volatility portfolios, therefore they will naturally deliver lower long-term returns relative to the balanced or aggressive categories. And members should avoid comparing these portfolios directly to higher risk options. Any decision to move out of the default strategy into a different risk category should be supported by professional financial advice to ensure alignment with retirement objective and risk tolerance. Thank you. I'll hand over to Solly to take us through the next section.
Thank you, Zanele. Yeah, I think great insights overall from our investment specialist. We have come to the Q&As, and we would just like to pause here and then just answer any questions that people have posted. Just looking at the Q&A there, a couple of people have posted interesting questions. I will read them out for the benefit of all, and then I'll be asking our investment specialist to answer those questions. So the first one relates to asset allocation. So within the Sanlam accumulation portfolio, there is a negative cash allocation there, so specifically SA cash. And the question is there any reason for that? Matimo, do you perhaps want to take that one?
Yes, thank you very much, Solly. So yeah, in terms of the negative cash allocation on the asset allocation, so the reason is because when we do the asset allocation calculation, we do it at a point in time, so at the end of the month. So on that particular day, we try to do the asset allocation when all the trading has settled within the different accounts. Sometimes it happens that there is a pending settlement that is happening when we are doing the asset allocation run. And then as a result of that, it may reflect as a negative within the cash allocation. But I can confirm that it is just a point in time. There is no particular reason as in the negative cash allocation, except that it is the outstanding settlement during the point in time when we are doing the asset allocation calculations.
Thanks, Matimo. The next question I think is for Adash. So this relates to the life stage strategies and the last 6 years just before retirement, where we are transitioning members from accumulation phase to preservation phase into the capital protection phase. This is happening over 6 years. The question is there some science into that? Why not 5 years or why not 7 years?
Thanks, Solly. So at Sanlam, we've done lots of research, extensive research on determining the life stage strategies and the timing of the life stage strategies. We believe that 6 years is optimal because it gives members enough time to transition. So we transition via 50 monthly switches into the Sanlam Capital Protection portfolio from your accumulation phase portfolio. So that takes place over 4 years. And then once a member is 100% invested in the Sanlam Capital Protection portfolio, they then have 2 full years spent in this portfolio, building up to their retirement. And we believe this is optimal because when a member is approaching retirement, they don't need to nervously watch the market in the months, weeks, and days building up to their retirement, because they can rest assured that their retirement savings are secured and that they won't experience any drawdowns or negative returns, which will significantly reduce their retirement savings. So we've done significant research on this in terms of the timing.
Thanks, Adash. So a related question was, this transitioning is in relation to the normal retirement age for members wanting to retire earlier or later. So the question is, can that be adopted for those members? And I think the answer is members who plan to retire earlier or later should be active in terms of making a member choice selection there. So the transitioning is based on the normal retirement age. Do you want to add anything extra there, Adash?
I agree with you, Solly. It's the life stage model can be adapted to your planned retirement age. So everything is relative to your specific retirement age, not just 60.
Okay, so while I have you, Adash, just a confirmation that members are automatically transitioned. Members that are in the life stage strategies, they're automatically transitioned. Do they need to do anything, or are they automatically transitioned?
Members don't need to do anything. If they are invested in a life stage strategy, the transitioning, the de-risking, the monthly switches, all that happens behind the scenes. Members can sit back and relax, knowing that their retirement savings is being handled properly.
Thanks. I think this is important because most members don't make choices on their investment strategies. So for those members who don't make any choices, it's good that the fund is automatically transitioning them from growth portfolios to more conservative portfolios as they approach retirement. Just a question on allocation of alternatives. Specifically, the portfolio that was referenced here is the Sanlam Wealth Creation portfolio. Matimu, are you happy to take us through that just to give us an idea on what the allocation looks like within that bucket?
Yes, thank you so much, Soli. So in terms of the Sanlam Wealth Creation alternatives allocation, so the total alternatives we had to end of December 2025 was around 8.2%. Around 0.8% we allocated to international alternatives, which was split almost evenly between private equity and private debt within the international alternatives. And then the balance of 7.5 we allocated to local alternatives within the Sanlam Wealth Creation portfolio. And then within the private debt of the local market, we had allocation of around 1.1%. And then within the private equity, we had an allocation of around 0.4%. And within the hedge funds, we had an allocation of around 5.9%, taking the total for local alternative to 7.5% and international alternative to 0.8%.
Thank you, Matimu. I think the next one is for Meghna. In terms of the performance that we're showing, so those are gross of fees. The question is, can we show net of fees investment returns?
Yes, we definitely can. But to answer that, I would say it's better if you contact your CRM, which is your client relation manager, because different participating employers will have different fees. It's all dependent on the AUM, on the amount that you have invested. If the participating employer has invested a much greater amount, you move down the sliding scale to a different set of fees. So we like to keep it general in these webinars and just show gross, but you can definitely inquire about the net returns, and we can calculate that for you based on the fees applicable to the specific participating employer.
Thank you, Meghna. I'm just looking to see, if there's any other questions that we received. One question was on the investment performance. So the underperformance of some of the funds relative to the benchmark. I'm not sure if any of you would like to take this question, but I'm also happy to just give it a step, and then if anyone has anything additional to say, then we can step in. So typically what we see in investment markets is that when they are trending quite steadily, as we've seen in the recent years, active managers tend to struggle. And then when markets are going sideways or they are drawdowns, active managers tend to do well there. So over the last 10 years or so, global investment markets have been doing extremely well, and offshore managers have actually struggled to keep up with the benchmarks. Locally, just to give everybody an indication, and during 2025, if you look at what's been happening in the unit trust space, where there are more than 1,400 investment portfolios, the equity portfolios there, only 30% of those manage to outperform the benchmark. So it is still important to have active managers because they tend to do well in other periods in the cycle. So what we ensure from the Sanlam Umbrella Fund is that if the fund achieves the benchmark returns, that should be more than sufficient to well-positioned members, to position members well in terms of retiring, and also just against competitors if our benchmarks are challenging. So if the funds meet their benchmarks, we are comfortable that those will be peer competitive. So there are periods when active portfolios will do well, and there are periods when active portfolios don't do as well as seen now. Just looking to see if there are other questions. There is a question on if a member resigns before retirement, can the member get full amount of their funds, or Sanlam keeps the money for retirement? I'm not sure who would like to take that question. And I'm thinking this relates to this the 2 pots or the 3 pots. So where the vested pots, it was easy for members to take their full value. So I think there's an additional complexity here, the admin complexity, in that members have to specifically instruct the fund on where the savings pot will go, and also the retirement pot will go. So if there's no indication on where the retirement pot should go, then that stays with Sanlam, and this is applicable to all funds. So we are expecting that this could be an industry issue where members don't typically make those active decisions. You may find that members have retirement pots in many funds, and at one stage, I mean, our view is that the regulator has to step in, or the industry has to help in terms of how do we consolidate these retirement pots. So this is something that the industry is grappling with. I think this is all the questions that we had for today. But yeah, I just want to thank everyone who joined the webinar. Hopefully you got great insights from our investment specialist. And thank you very much for the time that you took, our investment specialist, to just unpack the performance on the umbrella fund, and also just touching on the investment strategies. Until next time, take care. Goodbye, everybody.